I'm Cynthia Rowland, and this is episode 95 of EO Radio Show. This is the second in a series of episodes studying financial fraud at nonprofit organizations. With the expert insight of Sly Atayee, a director at national accounting firm BDO USA, and a certified fraud examiner, we continue our discussion following the previous episode looking at real-life case studies of fraud at nonprofit organizations. Today we talk about steps your organization can take today to mitigate fraud risks. In the next episode, we'll look closely at fraud prevention techniques for exempt organizations. Our last episode in the series, Ask a Certified Fraud Examiner, will answer listener questions sent to our mailbox at EO Radio Show. Welcome to the EO Radio Show, your nonprofit legal resource. Brought to you by the Exempt Organizations Group at Farella, Braun & Martel. My name is Cynthia Rowland, and I'm a partner at Farella. I'm a business and tax lawyer with more than 30 years of experience advising clients on nonprofit and charity law. Through this podcast, our lawyers and guests will discuss a range of legal and business issues impacting the nonprofit world because we understand you work hard every day to make your community a better place to live and do business. Many of our programs focus on the basics, and at times we'll do a deep dive into narrow and complicated legal issues. Again, welcome to the EO Radio Show. We're glad you're here. Today, I'm delighted to be joined again by Sly Atayee for the second of 4 episodes where we study financial fraud in nonprofit organizations, looking at what happens when fraud is uncovered and then studying effective techniques to prevent fraud in the first place. Sly is a director at BDO USA, and his work focuses on assisting exempt organizations with various aspects of forensic analysis and investigations. BDO is an international accounting firm that delivers assurance, tax, and advisory services to clients throughout the United States and around the globe. Sly has led numerous forensic analyses for exempt organizations, including fieldwork domestically in the U.S. and internationally in Africa, the Middle East, and Asia. He regularly supports his clients with forensic investigations, financial process redesign, fraud prevention and mitigation, internal control assessments, complex cost recovery calculations, policy and procedure development and support, and more. Sly has experience supporting litigation matters, substantiating costs through the collection of supporting documentation, and performing data analytics in order to calculate and quantify losses and damages. Welcome back to the show, Sly.
Thank you so much, Cynthia. Happy to be back.
So today we're going to talk about steps an organization can take today to mitigate fraud risks. In episode 94, Sly covered several case studies of fraud investigations. We're not going to go into all the details here of those case studies, so listeners who missed that episode might want to go back and listen to that to get the full context of these cases. Those episodes are great reference points for Sly's tips today. And we originally thought about limiting our list to 3 immediate steps, but it looks like you've got a few bonus tips for our listeners today.
Yeah, I started with 3 and I ended up with 8. So that just tells you that we have a lot to talk about here.
Yeah, great. So let's start with the first 3, which may not be the top 3, but the first 3 that came to mind, and then we'll do 5 bonus tips.
Yeah, absolutely. So we're trying to think of practical solutions for organizations, and a lot of orgs will hear, you need better controls. Well, what does that actually mean? It's not very helpful. And so from my perspective, I always try to give clients practical feedback and not just things that they're probably already doing, right? There might be some other exercises or tools you can create to try to strengthen your control framework or mitigate risks better. And so that's kind of the frame of thinking for this episode, which is, let's think about those case study examples that we gave in the last episode, but let's also just think about some best practices that in my personal work experience, I don't see a lot of organizations, doing these things consistently. And I think if you applied these steps or these tools or exercises to your overall framework of trying to mitigate fraud or other related risks, I think it would help. It would go a long way. And I think it would help a lot of organizations. And so that's kind of how we came up with this list. So just jumping right into it, one exercise for a lot of clients is doing some sort of self-audit. And what that means is something outside of your regular external audit that, an accounting firm like BDO comes in and does on an annual basis. The reason why this is important for organizations, and there's a stat from the Association of Certified Fraud Examiners that says that only about 4% of frauds are discovered as a result of an external audit, such as a CPA firm audit. It's interesting, but it also makes sense because auditors are not looking for fraud necessarily. They might indirectly, stumble upon fraud when they're looking at your controls, but at the end of the day, they're just validating what your financial statements say and if they're accurate or not. And so for organizations, we definitely say that you should not be relying on that, just given that stat, and doing other forms of internal reviews or assessments, kicking the tires, is helpful, especially if you have reasons to believe that there are risks that are there, even if you haven't heard of anything bad necessarily happening yet. This is also a little bit tricky for smaller orgs because they maybe don't have internal audit departments. It doesn't have to be a big, expensive exercise for you to undertake. It can just be a quick check, pull a couple of documents, pull a couple of files, supporting documents, receipts, and just do a quick scan every once in a while, right? So I think some quick checks, some spot checks could go a long way for organizations. That's the first tip.
So is that something that, let's think about a small organization that has lean staff. Is that something that maybe volunteer board members with accounting expertise might step in and monitor, or do you see this mostly at the staff level? Because there's kind of a catch-22. It's hard for staff to audit themselves.
Yeah, it's a great point. And that actually ties into the next point, which will be segregation of duties. But yeah, it could be anyone within the organization that's not the people doing the work. So if it's a board member, it could also be someone outside of the organization. So for example, we, as in our group at BDO, we do plenty of external audits for organizations that are not your typical financial statement audit. We'll come in. I've been in program or country offices in the Middle East, for example, and we jumped on a truck. We started cutting open boxes and counting parcels of food because they had concerns that certain food parcels were being intercepted and people were stealing food off the trucks. And so we basically we did an external audit. We did an inventory count just to give the organization confidence that the goods that they were buying were actually making it to the places that they should have. But yeah, it could literally be anybody outside of the people that are actually doing the work because you don't want people checking their own work. So board members, external folks, doesn't really matter who it is as long as it's someone independent. And this relates back to two of our case studies that we went over last episode. One was around the checking of travel receipts or expenses, right? I think in that case that there was a person that had been charging egregious travel expenses over the course of a year, and no one realized it because nobody was checking their expenses in detail, right? So again, travel is a pretty easy one for people to abuse. And then I think in the second example, we talked about an NGO organization that had payroll losses because somebody was stealing money from payroll. But if somebody had done a spot check on the detail of the payroll, you would have pretty quickly seen what we saw, which is the person was paying themselves 2-3 times what they were supposed to. And they were also paying their family members as well. The
payroll services, so many of the organizations now, particularly with employees scattered all over the world, seem to just hand off the payroll responsibility to a payroll firm. But those firms don't do any of this kind of checking on fraud, right? I mean, they just rely on the information someone in the organization gives them and says, here, write these are the payees and these are their paychecks.
Yeah, I mean, they will to some extent. And just even given the fact that someone outside of your organization is doing the payments, that's a kind of segregation of duties on its own, which mitigates some of the risk of something bad happening because they're a lot less incentivized to steal your money, I guess, or to
send hope.
Yeah, right. You would hope. But yeah, so those orgs will do some checks and balances for you. But again, even having an outsourced accounting function, that by itself, it's a way of doing segregation of duties, or if you're just resource strapped and you have to do it from that perspective.
Yeah. And it also, I think, chills the likelihood if there is a third party involved rather than a single person approving their own expenses and signing the checks.
Exactly.
That's pretty tricky. Okay. So what else have you got for us?
So the next point I mentioned is segregation of duties. So that's a key control point for any process, any financial process. But the way that you would actually put that into practice is, let's say, for an example, for an international organization that has a lot of country offices, right? If you have 20 offices, you have 20 different finance functions that are implementing your programs in whatever countries that you're working in. So even just doing a quick segregation of duties check, as in you can create a matrix to say, who's the person that's processing payroll? Who's the person that's making payments? Who's the person that's doing bank statement reconciliations? And if you kind of list all those out and you go figure out who are the people that do those things, those key financial steps in each country office, you might see that it's the same person doing multiple steps within that country office, which means that there's probably a lack of segregation of duties, where if that person's posting journal entries and then they're also doing the bank rec, they're essentially checking their own work, which you don't want that to happen, right? That's an easy one where it doesn't take that much time. It just takes a little bit of sleuthing and make some phone calls, send some emails, but doing that kind of quick check on a frequent basis just to make sure that even from a segregation of duty standpoint, you do have responsibilities divvied up in a way that spreads the risk across multiple employees.
Yeah, I think that's so important. And even in client situations that have outside legal counsel that are relatively well advised, I still come across, to my surprise, situations where an executive director is approving their own expenses. And it surprises me when that bubbles up and, it's like, well, no, obviously that's not a good idea. Somebody should be looking at this. At a minimum, if it's a really thin organization, somebody on the board is going to have to step in and take over that.
Just having another set of eyes. I mean, in general, if you look at fraud stats, the odds of one person committing fraud versus two people being complicit, adding that second person, it drops the probability way, way down.
Yeah,
right? It's all about mitigation. You can't eliminate fraud risk, but you can take certain measures to reduce the probability that fraud could occur. This obviously relates back to case study number 2 as well, which was the NGO example. That one person was booking journal entries, paying payroll, doing bank recs, and sending the monthly reporting back to headquarters.
Yeah, that's just an invitation. And particularly with remote work, people aren't in the same office. They don't have to face you day to day, and it's all just remotely dialed in, and who's going to catch me?
Exactly. Next point, and I'm sure, Cynthia, you have a lot of experience with this, is strengthening your compliance program. That includes all your trainings, your policies and procedures, different types of audits that you have. I think one of the biggest and most overlooked aspects of this is your training and making sure people are aware of what fraud looks like, some of the behavioral red flags. And a couple of examples related to our case studies, these individuals were showing signs or red flags that something else was going on. They had kind of closed themselves off in the organization. They refused to share responsibilities with others when it came time to reevaluating processes. The one, as part of the NGO, was flaunting expensive jewelry and I think it was a car. They had a brand new car. So again, it's important that people understand kind of those behavioral red flags so that they can look out for those things. And then that would actually relate back to one of my later points around whistleblowing and making sure people are aware of those mechanisms as well.
That's really important, kind of a reality check of somebody who's living way beyond their means. And you may not know. I mean, that's hard to tell, but that might raise a red flag. Your next point, number 4. So now we're into the bonus round.
Yeah. So background checks. Again, I think most organizations have some form of background check that they already have implemented, but it's good for you to understand to what extent that goes to. We do have several clients that have had fraud cases where the person that defrauded the organization had also defrauded their prior organization. And when we asked, did you guys make the phone call when you hired this person to the other organization? The answer is no.
Yeah. And a lot of times former employers will only say, did the person work there? They'll only answer the question of whether they work there or not. But you still need to ask the question. And
exactly,
there may be some information. I remember my other point from strengthening the compliance program, which reminds me, in the financial services industry, many of the people I know say their organizations require a mandatory 1 or 2 week vacation every year so that the person involved in the finances is absolutely gone, and anything that's a regular payment that they could be picked up by another person. Now, it's pretty tough in a small organization to require vacations, but maybe that's a red flag. Somebody who never takes a vacation and is involved in a finance, or a money supervision function.
Yeah, I mentioned 2 of these cases, 2 of the case studies that we went over last episode. The issue came up because somebody new came into the organization and they took over a responsibility that somebody else was doing prior and probably not paying too much attention because they've been doing that thing for a long time.
New questions, new eyes on anything, whether it's just an interim thing because someone's on vacation or a new hire, and giving that new hire not just the permission, but also the direction to take a look at everything and raise questions. If something catches your eye, report it back to your supervisor or the board or something, depending on the context. But yeah, that can be really helpful.
Yeah. And that's a perfect segue into point number 5, encouraging and educating on whistleblowing. Again, I'm sure most organizations at this point have some sort of whistleblowing function. If you don't, then obviously that's something you need to look into and maybe work with your outside counsel to build that. But even if you have one, people need to know where it is, how to access it, how to use it, and then where does that information go, right? Because if there's not confidence that, their anonymous tip is going to stay anonymous, that might keep somebody from making the tip in the first place. And we deal with plenty of organizations that have a whistleblowing hotline even, but their employees out in the field don't actually know how to access it. They just remember a training that happened 3 years ago, and there's a slide deck that exists somewhere out in the world, but they have no idea how to find it or how to access it.
So how frequent of a training program do you think is effective? This is probably not an answerable question. For a really large organization that has a lot of staff turnover, maybe you would do trainings, not just whistleblower, but, general fraud prevention techniques more frequently than for a small organization. I don't know. Does the field change that much that you need to update it from time to time with your outside advisor? Or is this just part of the intake process for new employees?
I would say definitely part of onboarding, but an annual refresher doesn't hurt. It's just a quick 30-minute training to let people know, like, here's what it is, here's how to find it, here's where it goes, here's the process and what it looks like on any tips that do come in. So I'd say onboarding at the onset of an employment, and then at least annual going forward.
Yeah, that seems right, especially if you have a large staff working remotely, a lot of people touching where money is going. So yes, whistleblower policies are really important. I have those in all of my formation documents. It's standard operating procedure to give organizations a whistleblower policy, but a lot of times I have no idea what happens with it after that. It may just gather electronic dust. I don't know. What does something do if it's an electronic file and nobody ever reads it? So whistleblower policies. What about other policy tips? I think we're on to tip number 6 now.
Yep. So number 6 would be related to enforcing your policies, right? So if we think about case study number 1, we talked about last episode, there was a travel policy / credit card policy the organization had in place, and they had rules written on it. But there was an employee submitting expenses every single month, and those employees' expenses were violating the policy. But the organization wasn't doing anything about it. The people looking at those expense reports weren't saying anything about it. And so they kind of set a precedent to say that this is okay from the organization standpoint. And so this went on for the better part of a year. And so your policies are just pieces of paper unless you actually enforce them. You want to make sure that you're making it clear to people, you're giving refreshers on what the policy contents are. Again, annually is probably a good idea for your more important policies, including things like conflict of interest. But you want to make sure that there are mechanisms set up to actually enforce your policies, not just communicate them to people, because otherwise people don't really, I wouldn't say fear is the wrong word, but people need to have the awareness that that's out there. And then if I violate the policy, it will come back to me, versus if I violate the policy, it just seems like no one actually cares and we just move on with business as usual. Right.
And not only for the person who's the potential bad actor, but also for all the other staff around that person. So reminding people, it's like, if you see something, say something. These are our policies.
Yep. Number 7 would be around recalibrating your signature authority. So what this means is that most organizations should have a signature authority, which says up until certain dollar amounts or on certain types of transactions, these individuals can sign, right? So for example, like anything over $100,000 has to be signed by the CEO or the executive director of the organization, right? What recalibrate means is go look at your data, look at your purchasing data, go pull out a year's worth of your last year's worth of data, see where your thresholds naturally actually exist versus coming up with an arbitrary dollar amount. Some organizations have $1 million threshold. If you go look at their data, they may not have had any transactions that actually went over $1 million in this last year, right? The threshold you set doesn't actually help because it doesn't align with your actual purchasing behavior. That's when we tell organizations, like, reevaluate those thresholds you've set and make sure that they align with your risk tolerances And so some organizations will choose very low thresholds and say anything over $1,000 needs supervisor management approval. Other organizations that are maybe larger will also say, like, we're okay with higher dollar amounts being the only ones that go to the CEO or the ED. Just a recalibration sometimes makes sense because sometimes we set those thresholds based on arbitrary dollars instead of real data.
Yeah, I certainly do in my initial organizational resolutions. Just send it out with, for a new entity, I have no idea. And so it just gets sometimes baked into the governance documents without further thought as the organization grows and becomes more active. So that's a great tip to take a look at that from time to time.
Yep. And then our last tip, number 8, really having some sort of accounting expertise on your board. A lot of organizations have already thought about this, but you really just want to make sure that there's someone on the board that understands and has some level of accounting and finance expertise. They can give some guidance on building internal control frameworks, understanding how to build control environments from a policy procedure standpoint, which again, if you work with your outside or in-house counsel, they should be able to give guidance on that as well. But then really building those key control points within your financial processes, understanding the segregation of duties and those principles. But just having that voice on the board is a really helpful tool and mechanism where, it's a pretty specific skill set and some organizations may have it or they may not. So I think that's a tip for a lot of organizations, just to make sure that you are spreading the wealth and have a diversity of opinions coming to the table in terms of your board.
Yeah, that's a great idea. So this has been quite a lot of tips, way more than the 3 that we promised in our initial episode. I can't thank you enough for being willing to write these down and list them all out for us. And in our next episode, we'll talk about general techniques and kind of some bigger picture overviews on fraud prevention techniques. But anyway, thank you so much for joining me today. And I look forward to talking to you again to set up the next episode. And then finally, our Ask the Certified Fraud Examiner episode, for which we're inviting listeners to send questions for you to answer, Sly, at the end. So thanks so much for being willing to share all of this amazing expertise with the listeners.
Super excited about those. Thanks, Cynthia.
So that's all for this episode. Be sure to check out the show notes for links to resources that'll be helpful on these topics that we've talked about today. Also, Varela Braun Martel has a YouTube channel with organized playlists for all of the nonprofit EO Radio Show past episodes to make it easy to find information on topics relevant to you. I'm Cynthia Rowland, and you've been listening to EO Radio Show, your nonprofit legal resource, brought to you by the Exempt Organizations Group at Varela Braun Martel. If you have questions that you'd like to ask a certified fraud examiner in our upcoming episode at the conclusion of the series, please email us at eoradioshow@fbm.com. That's eoradioshow@fbm.com. Thank you for joining us. Until next time, make a difference.